We got some setups coming in on the Edge Finder here this week. For sure, we've got Nikkei, Dow Jones, DAX, S&P, copper, Bitcoin, oil. I mean, you've got a lot of different potential bullish readings going on in the Edge Finder. And if we flip it around, well, let's just take out the neutral readings. You can see we've got some interesting stuff here, guys. Gold and silver are getting bearish readings on the Edge Finder. So is that going to be a trade setup for this week? Let's see. Let's see. If we could take a look at gold here, for example, this is not a chart that I want to sell. I'm going to go ahead and say that right now. From a technical perspective, I don't love the idea of shorting gold. But I'll tell you what would get me potentially bearish would be if you actually saw breakouts to the downside on this one. So if you see, this kind of move here, if you get a breakthrough support, that could be really interesting. You start to see breakouts, lower lows, lower highs, that sort of scenario. Definitely interesting. We've got stocks a little bit lower here this morning. NASDAQ down the most by 0.3%, quarter of a percent down for S&P 500. Gold's down mildly. Silver's down 1%. It was down a lot more actually previously, but we've got a little bit of a bounce back on the silver chart. So what flipped? Why gold bearishness? Well, let's break it down a little bit. Last week, we had some employment data that came in pretty weak for the United States, and that's dragging the score here for gold. If you notice, again, jobs added were very strong last week, and unemployment rate went down last week. It was a win for the U.S. economy, and a win for the U.S. economy is not particularly bullish for gold. So we actually have a bearish reading on gold. Now, again, does that mean that I go out and short gold just because the Edge Finder is bearish on it? No, I'm still waiting for a proper setup. The Edge Finder is not a crystal ball magic machine. It is simply an economic data screener. And so when I see that we have a potential bearish setup, then I'm looking for technical price action to actually give me the setup. So I might look to short it if I can get the setup. So what I'm looking for on gold would mean, or what I'm looking for would entail a break of this support level. Now, what if we just don't break that? What if we just break to the upside? Well, then there's no trade for me. I'm not going to short into just an absolutely beast mode strength chart. But if we start to see, resistance start to hold, if you start to see sellers making a move on gold, then you might entice me, right? And most of it, guys, goes back to the dollar. The dollar index is looking real strong right now. Here's a daily chart view. We discussed this last week a lot. The dollar index is breaking out, it looks like. And this is a chart that I really like, especially if you get a pullback into this area or a break and retest of this area. I'd classify myself right now as bullish on the dollar. And it's been a minute since I've been bullish on the dollar, but last week was so good. So let me break down here why I flipped more to the bullish side of the US dollar. It's because last week we got just winning economic data. So let me show you services PMIs first. Services PMI make up like a huge portion of the US economy. We're a services-based economy, as they say. And what you can see is that services PMI last week was a big hit. And this is a pretty important reading. The Purchasing Managers Index essentially surveys a bunch of decision makers in corporate America on where they see things going. Do they plan on hiring people? What are their inventories looking like? How are sales projections looking? And if those numbers, if they get survey responses that are very strong, it is usually a forward-looking indicator of the economy. So last week, we got prints from the surveys were very strong. 54.9 compared to the forecasted 51.7. So, this signals to me that the US economy last week showed signs of being more upbeat than people thought. This is just one. There's more things I want to show you. The big one, the obvious one, was the NFP report last week, right? Jobs added last month were really solid, 254,000 compared to a forecasted like 150 or so. What was the forecast? 147. So before I move on from this, a lot of times people will point out that they revise numbers lower for the jobs data very frequently so that, you can't trust these numbers. And that may be true, that may not be true. I'm not a conspiracy theorist and I don't know. Like I can't give you any proof to or from this data point, right? I don't know, and you don't know either, right? We're not the Labor Bureau statistics. We don't have, if they're fudging the numbers, then how are we going to know that? We don't know. Now, they did revise a bunch of stuff in the past year down, so that is fair to point out. But they actually revised the previous month of August, they revised those numbers up. So there has been a tendency to revise numbers lower. But last month, not only did we beat jobs, but we revised the previous month before that higher. This yellow line, by the way, guys, we've mapped this out in the Edge Finder. The yellow line is your revisions. So you can see that oftentimes we're revising, lower. Sometimes we're revising higher, sometimes revising lower. Last month, we got upward revisions and we got very strong beats compared to expectations. So when I look at the labor data, and I say, look, this stuff is coming in strong, that is an upbeat thing for the US dollar. That's going to lift expectations for dollar strength because it's going to reduce expectations about rate cuts. Remember, the Fed likes to cut rates quicker when things are looking more tough in the US economy. But jobs data being strong is going to limit how many rate cuts we get if that continues to be the theme. Now, you could be, somebody who thinks, well, that's just a blip. It's going to go back down. It's going to get worse again. And you might be right. But right now, the dollar is operating off of what we got last week, which was upbeat numbers in the labor world. So I just want to point that out right now. Even if it's short term, dollar strength seems to be the path of least resistance, in my opinion. And so if we get dips, I am looking for upward strength. And I also should mention that this strength in the labor data and the PMI data is impacting things very heavily on the Edge Finder. As I mentioned, we flipped into bearish territory for gold and silver, and we flipped way stronger into the indices. The Dow Jones is getting a bullish reading. The Nikkei is getting a bullish reading. Bitcoin, S&P 500, US oil, things that potentially could benefit from a stronger labor market and a stronger economy, like oil and the S&P 500 and copper, are seeing more strength in the algorithm's output in the Edge Finder.
Oh, Chris Pulver took a trade in our Discord.
Oh, really? Let me see.
Pulver alerts are now available in the A1 Trading Discord. If you want access to everything Chris Pulver is trading, click the link down below or click the link being dropped in the chat now to speak directly with a team member.
The US economy is looking not too hot that it's going to be inflationary, but not too soft that it's going to look recessionary. And that leaves us in a pretty good spot for outlook. Now, again, you might point out, well, Nick, stocks are valued really high. You might say, this is a bubble. This is going to be an overvalued market that collapses someday. And if you say that long enough, you're going to be right. But markets trade on sentiment. And one key sentiment indicator here is that we've got an election coming up. And it doesn't matter who the president is, the standing president is going to do what they can right up to the election date to inject money into the pockets of consumers to make them feel better going into the election. That's not a Democrat thing. That's not a Republican thing. That is a human thing. If I was the president, that's what I would do too. Because you want to make people feel the best possible right before they go to elect again. So that is another tailwind to the markets in the short term. Now you could argue in 2025, it's going to change. Things are going to, go worse or go better or whatever. But right now, I'm a market trader. I'm trading what is in front of me. Right now, we've got good labor data. We've got inflation coming down. We've got an election ahead of me. So I am bullish. Now, that doesn't mean the market can't dip. It totally could, but I would be a buyer of those dips until proven otherwise, right? I think that dips in this market are innocent until proven guilty. So if you get a big dip, I'm not saying you hold on to this with your whole, life, and if it crashes, then you just go down with the ship. That's not what I'm saying. I'm saying that as a trader, I might look for these pullbacks with stop losses below structure and try and continue to let the rally, do its thing. It's been trending and trending and trending. Just something to think about is that and I've seen some research that's basically shown that like when the market itself, when there's lots of companies participating, it's a stronger rally and it has more sustainability. I saw some, you'd have to go find this thing I found, but it was like a research, one of those like 50-page PDFs on historical stock market stuff. Like in the event that you have a larger portion size of stocks rallying, it is usually a more sustainable rally. So to see that recently has been really positive. A great way to check that is to take a look at the RSP, which is an ETF that tracks the S&P 500, but it gives an equal weighting to every stock rather than heavy weighting on the biggest ones. Like the SPY, if you pull up that ETF, that's putting a lot of weight in Apple and Nvidia and Microsoft, but the RSP is putting equal weight into every single one of the 500 companies in the S&P 500, which arguably gives you a better read on how the average performance of the stock market in the large cap world is doing. And so you can see that thing has actually really started to pick up the pace, which is great news for the state of the rally, in my opinion. When you get it going sideways or down, that's saying that the average company is not really enjoying the benefits. But now with rate cuts on the way, with labor data coming in decently well, I think we're looking okay. And I'm a buyer of dips until something changes. Now, hear me out. People will say, Nick, you're buying near an all-time high. You're trading this thing long, maybe right before a big crash. But you could say that at any point. And eventually you're going to be right. If you said over here, stock market's going to crash, well, the next time you got a big dip was months and months later, and it didn't even come back to that area. So the difficulty here is that if you're going to be bearish, you also have to be bearish at the right time. Otherwise, you miss out. And that's the difficulty of just shorting these things in general, is that unless you catch a full-on, downtrend in the market for a few months or years, it's very difficult. So just food for thought. It's generally why I do tend to be on the long side. But even if you're a perma bull on the stock market, as a trader, you have the luxury of picking where you want to be the most allocated. So for example, I personally am more heavily allocated to semiconductors within the stock market. So I'm not just buying and holding the index. I'm trading in and out of sectors or portions of the index that I like better than others. So I like semiconductors because they have massive sales growth and they have massive earnings growth. And I think that they have a lot of strength.
Pretty low impact day, up on the day, which is always a good thing. We gapped a little bit lower. Let's take a look at a little bit of everything. My dog seems to be pretty indecisive today. Just want to hang out. What's up, bro? So we're dealing with a lot of chop. The big catalyst this week is going to be Thursday with the CPI news coming out. And I want to talk about that for a moment, kind of repeating what we've been mentioning here on session the last couple of weeks. Let's have a look at the calendar. So this week, all light impact, we were up on volatility a bit. So volatility, here's VIX, and if we go to VX for VIX futures, also up on the day. Probably a lot of this is due to oil, I would imagine. We've got another pretty big rip to the upside on oil. I actually did close out my CL positions. If anybody's in my pulver alerts, there's two trades that we had. One of them was it was a 65.50 sell put and a 64.50 buy put. We collected about 50 cents credit, and I closed that one out. I think I closed it for like a 25 cents debit or less, and so that should have been about $250 per contract profit. So that trade is done and closed. And then I also had one that had a little bit more risk to it, and I just closed that out today. It was a 65 sell put, and I did one contract, and then I did a 55 buy put, and I did two contracts. I collected a net credit of $1, and today I closed out, so it was $1 credit, and I closed out for 49 cents debit or less. And so the reason I want to get out of that trade is I don't want to be sitting here with the exposure of, what oil is going to do if we have more crazy stuff. Like, obviously I was in based on support, the geopolitical event that helped this squeeze happen. You have to remember, like, hedge funds were crazy short, commitment of traders and advisors were crazy short. I just had another trade close for profit there, 250. Get that one updated. That should have been trade number 4. Edit that one today. So I've got 4 for 4 little winners today. Not too bad. I'll get right back to my train of thought here in a minute. Filled and closed for 15% profit target. Very nice. Okay, so going into the charts, and that one just got filled for profit as well. Well, that was pretty easy. Okay, so filled and closed for 15% profit target. All right, well, a little 5 for 5 in the SPX feels pretty good today. And I think I actually might take... Am I getting greedy if I take another trade? Probably. 5 for 5 is pretty good. All right, let me get back to the thoughts on oil. So I was taking oil based on the technicals of support, okay? So the fact that we had the geopolitical event where nobody knows now. I mean, if we have damage in the Middle East and we have conflict in the Middle East and oil prices go up, makes sense. But what I didn't love is that oil prices were dropping even in the wake of China coming out and doing stimulus and having that 2-week run where China stocks could do no wrong, and they're still ripping like crazy. It wasn't until we had the tensions in the Middle East that then jumped price higher. Now, and I say that because what I don't want to see is oil prices then turn sharply lower, and my $65 put, which was right here at those lows, that is threatened. And even if it doesn't go below 65, the velocity in which it can move, and especially if we go lower, that trade has a lot of risk on it. So I was risking about $2,000 on the trade, and I just wanted to get rid of it. So ended up making about $150 profit today, and I'm just taking the profit and moving on and eliminating the risk. I don't want to be kind of exposed, especially if it was a credit spread, wouldn't be a big deal. If it was just a credit spread, wouldn't be a big deal. But because it was basically a cash secured put, I'm not going to take settlement on CL was my instrument here, but I'm not going to take settlement and say, like, okay, go ahead and give me oil. I'm not going to do that. So the fact it was just up 50%, taking the profit, moving on, and that is the day. So CL is done. Let's take a look at everything else. Natural gas is pulling back a little bit. I actually don't mind looking at some natural gas in something like this. I hope natural gas actually does something like this, pulls back to around $2, and I'll probably get a long position with a credit spread. So I'm going to bump this up. I have a chart alarm set at these lows, which haven't been tested. So I'm going to set this at $2 here and go to like 2.00 and then put in a potential bull put spread and just give myself a heads up that I can take a trade on CL or on NG rather. Gold. Super sideways on gold. This is my plan moving forward for gold. We're sideways. I hope that we can continue to stay sideways or just have this very light drift to the downside. And let's find the 50. Let's find the 100. There's also a chance that nothing happens here. We might just go sideways, sideways, sideways on gold. And the 50 period might end up catching up to price. And that's okay too, because if we go sideways and then just find the low here, I might have to just say, well, I guess I'm just going to buy more gold. And that's understandable, but I'd like to see if price can dip between like the 50 and the 100. And that's the only way I'm going to kind of justify like getting in at these highs. I mean, I'm still running with gold to the upside. I, of course, want it to go higher. I think, traders, investors are pretty excited about gold going to 3,000. I mean, that level can certainly get hit. I would like to see a pullback first. I thought that the dollar impact would have a little bit more of a pull on gold, but it didn't. I mean, you take a look at the dollar for the last like 5 trading days. Outside of today's pause, 1, 2, 3, 4, 5 days in a row. That's a big move on the dollar, and gold did nothing. So, I mean, we had the dollar move about 2.5%, and gold did nothing, right? So if there's a lagging effect, maybe the dollar's already been kind of priced in for a bit of a squeeze. If gold shows a little bit more follow through with that stronger dollar, perhaps that gives me the pullback that I want. Just take a look at the structure here. Gold looks really, really good to just focus on buying some dips. That's it. Just focus on buying some dips. So if we pull back into this 50 period, that's 25.50. Between 25.50, 2500, I'm going to add to GC. I'm going to add to GLD. And I will dollar cost averaging on GLD. I'll probably take some options trades on GC. Silver. Silver is above the structure. There's two things I'm watching here. If this is a break and a pause, if it just gets a nudge higher to the upside, that could be a nice bull flag. I'm hoping it's not this. I'm hoping it's not past resistance and support. So this would be resistance here, holding, and then past resistance that is now support around 26. I don't really want to see silver come all the way back down to 26. Now, if it does, okay, fine. I'm still interested in adding long positions here. But ideally, I would like to see silver do this. Either just keep going slightly higher and then getting to my measured move around 35.80, or we have it hitting, pausing, pulling back to the backside of this trend line, and then making another push higher. Now, I do wonder if gold and silver make a push higher at the same time, or if we have to do a comparison. Here is gold versus silver. And over the last couple of years, we really haven't had a crazy outperformance by one over the other. So we have some pretty good structure. If you look at gold versus silver, right now, it looks like silver can get the upper hand if we just continue to push a little bit lower. That gives silver a slight outperformance. But from there, the nice thing is even though this has been going back and forth, both assets individually, I'm looking to go long on both of them. So all this is helping me kind of time, do I think that silver could outperform gold? And maybe I can add more silver positions to kind of play that more aggressively. Or do I think that gold can outperform silver? Does that make sense? So if we're sitting here at the low, here's a question, everybody. If I'm sitting here at this low on gold versus silver at $76 at this level, this is support. What would you do down here? Would you add more to gold or add more to silver if you're down here at the bottom? Hopefully this makes sense in doing the comparison between gold versus silver. If we're sitting at the bottom of this chart, I'm looking to add more gold to my portfolio because if we go up, gold is probably going to look better as a performer than silver. If we're up here, I'm looking to add more silver versus gold. Does that make sense? So this is a way to kind of figure out which one I want to allocate more to, maybe take on more trades, add more credit spreads. So it just depends on where they're at. But both instruments overall, I'm looking to go long on gold and silver.
I'm bearish on dollar, bearish on yen. Dollar's rising, but who cares? But regardless, we're going to get there. Rate cuts by the end of the year. At the moment, there is a 94% chance we're going to cut again in their next meeting. We have a 25 basis point rate cut expected from ECB, from the Bank of England, from the Bank of Canada, from the Bank of RNB, which is tomorrow. It is tomorrow, which is a 50 basis point rate cut, which is massive. Joking, but it's a double, so it's better. It's better than nothing. So those are the rate cuts, and of course the SNB. I had a meeting earlier this morning with the mentorship students, and it was in the VIP webinar. It was really fun because there was people asking questions. But what I said there, or I problematized the relationship between SNB and Bank of Japan and what might be happening. Anyways, I wasn't planning on saying that, but regardless, there is likely no chance from Bank of Japan from the next meeting, but they might rate hike maybe December, January next year. That's out of the way. Let's go to the markets. What day is it today? Oh, I'm really happy to have me. Okay, cool. What day is it today? It is 1 month until the US election. Good answer. Not that that matters to anyone, but to me it matters because I believe we're going to be dancing around, maybe having a bottom by the time we get the election. So I'm a bit under the weather in terms of trading because there is no trend. We're not trending. We're going up and down. We're not going anywhere. What's going on? Gold is going up. Gold is going down. Gold is going range bound. We are not low. We are high, but we can buy. There's nothing. Sterling dollar yen. If you use pivot points, not that that matters to you, but it's about to get into a buy yet. I haven't bought yet because I'm waiting for it to fall. So that is about 113. So we are almost there. For Canadian dollar yen, we are still a bit high. I wanted to be down at 108, which is still very high. Euro yen, you're not even giving me $1 million, and I'll still not buy euro yen. It is ridiculous at the moment. That is 150 pips, or so 90 now. Oh no! That candle there is 40 pips. It isn't happening that I'm buying that one right now. The risk is giving me a heart attack. US data has changed. It came out stronger. Yeah, so the thing is, a GFX, it doesn't matter. Okay, it doesn't matter. If it came out stronger, because what it depends on is how do you interpret it, right? So I'd say that inflation comes in lower. That makes me bearish, flat out, right? And then every other number out there says bullish, right? The growth says bullish, PMI says bullish, job data says bullish. Okay, cool. That's your interpretation, right? The point is how do you read that two conflicting scenarios, right? So you have said is dollar bullish, great, right? I said dollar bearish, great. But I'm still going to wait for my dollar bearish setup. And I can wait. But you already have your direction. You already have things happening, right? So you win and I win. I just have to be a bit more patient, right? So don't worry. And I hope you're in profit since it's bullish now. So, Do you think your pound dollar will fall or move or not? But I don't know. Do you have any setups on it? Because it's kind of like telling me, is it going to rain today or not? Like, I can ask the weatherman, but it's probably going to fall more. But, it's my setup. It's not favorable to either direction at the moment. So, there's that. But again, GFX, that's your interpretation, right? I don't see 2.5 inflation as being better, right? I see it as being worse. And inflation is the leading indicator to look at. All right. And the difference between inflation rate and interest rate is now above 2%. So they should close it down, but that's all. But of course, they're going to cut in. They're still going to cut in the next meeting. They're still going to cut in December. So regardless, they're still going to cut. So does that lead to dollar weakness or not? It depends if the market priced in too much cutting, but that's all. I also said back when we were at the bottom on dollar that we had, going into the Fed meeting, everything was skewed to dollar rising because we had priced in too much in falling, too much bearishness. But okay, cool. For dollar yen, dollar is incredibly weak at the moment. So the only way is higher, to be honest with you. With the dollar strength as well on top of it, it's actually not too bad. I remember us being over here, and then I remember us falling. I was falling at 800 pips. It is a lot of pips going out here. So, to me, it's bullish. Mostly because of yen weakness. most likely. But when dollar gets weaker and yen gets weaker, we should probably range bound. But it is.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.